some basic things we're familiar with here. LE Company paid $45,000 cash to purchase raw materials. Okay, so cash is going to decrease. Raw materials are going to increase $25,000. Okay, it's easy enough. They put $16,200 of raw materials into production. Okay, well, take it out of here, and we have direct materials going in to work in process. Nothing really new here. We worked on that a little bit in Chapter 2. Okay, then they paid production workers $8,000 for the 1,200 hours of direct labor. Okay, well, we paid them. That's the direct labor. Okay, easy enough. All right, so we know that product costs are direct material, direct labor, and overhead. Well, we know there's some issues with overhead. Well, we know overhead is going to go into working process. We need to know overhead. Well, what's going to happen? We're going to finish some of these products. We need to sell them. We're going to need to know month end, time to do some analysis. We need to know how much cost, so we can go in and do some variance analysis, so we can go in and evaluate how well we're producing these products versus our cost. Do we need to raise prices? That sort of thing. Well, the electric bill hasn't come in yet. How do we know how much cost then we went into producing these? Well, we paid rent for the whole entire year way back January 1st. Well, should all that rent just be related to the products produced in January then? I don't know. That doesn't really seem to make sense. So normal costing. We're going to estimate how much overhead for the period, typically the year. Some cases, if you construction, your project's going to last over a year for that time period. Estimate how much overhead so that we can apply overhead throughout the period. Well, how do we do that? Well, we first, however you want to estimate the overhead, previous overhead, expected production, based on calculating how much overhead we think. We'll get into a little bit more on figuring out how to estimate the overhead later on. But for now, LE Company expects the total overhead cost for the period to be $7,700. That is expected overhead for the period. And they expected to use 1,100 direct labor hours during the period. So what does that mean? How are we going to apply overhead? Well, that means we need some sort of predetermined overhead rate so that anytime some sort of event happens that's going to trigger overhead, we can apply it to work in process to match it up to the products that are being produced, even if we don't have actual overhead yet available to us. If we're producing those cookies, we're producing them, electricity's running, but we don't know what that total cost of electricity is yet as we're producing those cookies. But we need to have something we can plug in to work in process to match up to those cookies that are being processed. So we need our estimated overhead, and we need to have it so that when an activity occurs, we're going to apply it. Now, traditional volume-based activity that we're going to look at, direct labor, machine hours, direct labor costs. For the activity-based, it's simply something that we think causes the overhead to go up. A cost driver. Some sort of relationship. Now, we'll find out when we get to activity-based costing, a lot of our volume-based cost drivers don't necessarily work real well. So let's keep it simple for now. So let's say they're going to use direct labor hours as their cost driver. Essentially what they're saying is when a direct labor hour happens, our overhead costs are going to go up. So they're saying that there's some sort of relationship between overhead costs and direct labor hours. Not really perfectly variable, but the idea is the direct labor hours go up, more overhead costs are happening. What makes sense is direct labor hours means someone's there putting the cookies together, running the mixer, but we're running more electricity, so maybe the electricity cost is going up. So we did some analysis, and we think that's going to be our best cost driver. So that means we need to know, we can count how many direct labor hours happen. That's something we can get immediately. So we can apply overhead if we believe this relationship exists. We can apply overhead on something we know. We know direct labor hours. We don't know what the actual electric bill is going to be yet, but we can get a good estimate if we think direct labor hours is some sort of cost driver for it. So they estimate that 1,100 direct labor hours will occur during this period. So then 7,700 divided by 1,100 dollars per direct labor hour. So now we have this. We do this at the beginning of the period. We have this going forward for the year. So anytime month ends and we want to know how much our production costs, we don't have all the actuals information in yet. Maybe we pay property taxes towards the end, September, but it's for this entire year, so don't know what that cost is, but it's an overhead cost. It's going to go on the pool, and we're using some of it now. So instead of waiting around for actual overhead, what we can do right now, we can say we're going to apply at a rate of $7 per hour. Well, how many direct labor hours actually happen during this time period? Well, we're told that. Pay production workers $8,000 for 1,200 hours of direct labor. Well, that means we can take our 7 times the 1,200 actual direct labor hours and apply overhead. Don't know all the actual costs yet. At this point, we haven't heard anything about actual overhead. As we know right now, nothing has happened. But we need to know the cost of these cookies. Or in this case, whatever L produces. So at the beginning of the period, we're like, okay, we're going to need to know overhead throughout this time period. Anytime that a direct labor hour happens, we're going to say that this relationship is $7 per hour. So, as direct labor hours increase, the cost of overhead should go up, and our estimate $7 per hour. Now, the good accountants should raise their hand and say, well, this isn't balancing. You only have one side there. What do we do with this? Well, it's not something we're paying for. We're just applying overhead. Actual overhead hasn't happened yet. The electric bill hasn't come in. We haven't paid anything for it. And technically, since we don't know what the electric bill is, we don't really have a liability yet until we know a rough idea of what it is. Yes, there's some accounting rules about when you recognize it, but this other side. We have a made-up account we add overhead control. Overhead control is kind of like this accounting bucket that we can use for our overhead. It's a magical bucket. We can take out of it all day long. So even though at this point we haven't put anything in there, overhead control, which is a temporary account, we can now make our equation balance. Overhead control is going to hold, when actual overhead comes in, we can put it here. When we need to apply overhead, we take it out of here. And then at the end of the year, when we close all our temporary accounts, we'll fix our bucket. But we can go forward. We can figure out the cost of what's going on here of these products. We can calculate cost per unit. We can run analysis reports. Yes, this isn't going to be exact. And we understand that. But we deal with a lot of estimates and unexact things. Because there's that trade-off between accuracy and timeliness that we all have to deal with a lot in accounting. Yes, you can get very, very accurate information if you're willing to wait forever for it. That's part of the reason that financial reports come out so late. The year-end report doesn't come out until, 2.5 months after the year ends? Well, they're trying to be accurate, so they're trading off the timeliness. Well, internally, you don't really have that luxury. Think about it. If you're going to wait forever to get the absolute accurate information, decision-making has passed you by. You haven't had the opportunity. You've gone 2.5 months before you made any changes because you waited around to find out that your costs are way too high. There's some problems. So we estimate the overhead. All right. What else we got here? They completed 3,000 units of product at a total cost of $19,000. We'll figure out how, again, I guess it's chapters 5 or 6. 7. Anyway, we'll get into figuring out how to do that later. 19,000 finished. It goes to finished goods. They sold 2,400 units for $25,000 in cash. So 2,400 revenue then. Over here, increase for cash. Then a cost of $15,200. So that will be the cost of goods sold. So for us to understand that those 3,000 units cost $19,000 to be able to do this, we have to estimate our overheads. We still haven't got the electric bill in yet. So now we are getting towards the end of the year, end of the period. Waiting for our books to start wrapping up. Then we find out we paid $7,200 in cash for various manufacturing overhead costs. Here, actual overhead is finally coming in. We've already sold items. We pay for it, and we throw it in our bucket.
You got constituted credits sold.
Yeah. Have what?
Constituted sold, so you only have 2 credits.
Doing that. I think because my stuff in 2020 and we don't do T accounts. All right. income statement, all that needs to be prepared. Okay, income statement, we told them that information. They can go and take care of that. Except, we need to clean up all our balance sheet accounts that aren't really balance sheet accounts. What do I mean by that? There's a few accounts that are temporary, that are on the balance sheet during the year, that can't be there when we create the balance sheet. Have you ever seen this account on a balance sheet? No. It's a temporary account. It's our temporary holding bucket. Well, so that means it needs to be zero. It doesn't show up on the balance sheet. But right now we have it listed under assets. Well, we have a problem here. That's not zero. What happened? Of course we weren't going to be exact on what we applied with what actual came in. There's various factors here. We had an estimate to begin with how much overhead we thought was going to happen during the period. Estimate how many direct labor hours we were actually, going to use during the period. And then, of course, we're dealing with, we'll talk about in the second part of Chapter 3, was direct labor hours really even a cost driver of this? So there's these problems that are going to result in a difference here. What happened? Well, we applied more overhead than actually came in. We over-applied. We over-applied by 1,200. So how do we get this to zero? We need $1,200 right there. Okay. That's nice. We just plug it in and get zero, but we're out of balance. What do? Temporary account, we're closing it. How do we close it? If it's immaterial, it's really simple. If in this case, since we applied overhead, we're going to close overhead control to cost of goods sold. If it's immaterial, and in most cases, as long as we've been at least decent on our estimates and there's at least a somewhat decent relationship here, it's going to be immaterial. And I'm not going to go over rules for materiality. That's going to vary by company. Most of the cases in here will say it's immaterial. Alternatively, if it is material, what do? Well, then you're going to allocate this $1,200 amongst the related accounts that cost went into. You're going to allocate it between work in process, finished goods, and cost of goods sold. Take a relationship of the balance in the three accounts, and you give it a weighted application where you would apply the cost. Nothing too difficult. It's whatever the balance is here, average compared to the total of the balances. And we'd put that percentage in work in process, the related percentage of finished goods. Most of the time, though, it's immaterial, and we just close it to cost of goods sold. Because what happened? Well, we actually recognize too much cost. And so we get a little bump here, cost of goods sold gets to go down. Okay. Some questions on the